Look at the average rate of interest rates right now relative to where we are in terms of effective interest rates that we're paying on the debt. Things are going to surge even further from here. So I think that that's going to become a problem. I can see the Fed having to cut rates irrespective of where inflation is, irrespective of where labor markets are. And it wouldn't shock me at all. So to me, that's critical because I think currencies trade in a relative basis. And if we see a devaluation of the dollar versus other currencies, I think that's what takes the next leg up for gold. Now, it wouldn't shock me at all to see, much larger levels, another $500 move in gold very quickly.
The global financial landscape has witnessed significant shifts recently, particularly in gold markets and fiscal policies. Tavi Costa, a member and macro strategist at Crescat Capital since 2013, has been closely monitoring these trends, offering insights into their potential long-term implications. The World Gold Council's recent report highlights a complex picture of gold demand in Q2. While overall demand, including over-the-counter investments, reached a record high of 1,258 tons, the highest Q2 figure since 2000, traditional sectors showed mixed performance. Jewelry consumption, for instance, fell by 19% year-over-year to a four-year low of 391 tons, mainly due to record gold prices. Notably, central banks have been steadily increasing their gold reserves. Net purchases rose 6% compared to the previous year, reaching 184 tons in Q2. This trend aligns with Costa's observations on the growing importance of gold in central bank portfolios, driven by the need for asset protection and diversification in an increasingly uncertain economic environment. Meanwhile, the United States faces mounting fiscal challenges. The Congressional Budget Office projects a federal budget deficit of $1.9 trillion for the current year. This widening deficit is partly attributed to rising interest rates, which have increased the cost of servicing the national debt. Additionally, mandatory spending programs like Social Security and Medicare are putting further strain on the budget as America's population ages. Costa warns of a potentially unsustainable trajectory for U.S. interest payments. He projects these payments could reach 4.6% of GDP by 2025, posing significant economic risks. The situation is further complicated because 27% of U.S. debt is due for refinancing within the next 12 months, likely at higher interest rates than the existing debt. Please tune in for our exploration of Tavi Costa's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
There's a lot of changes happening. We started, who would have thought that we would see this accumulation of gold by central banks like we've seen recently? I think that had a tremendous impact on the thesis, which we all believe that that would be the case. But disclosing those purchases to the way those countries have been disclosing, like China even, imagine what they're doing undisclosedly. It's a very important question. And so, what we're seeing in terms of that is a huge wave of the demand for gold that we think it's going to be even more. Now, I've always been of the view of long hard assets, and I've been growing this conviction now that been short the US dollar versus even other fiat currencies. I've never had that view before, and I certainly do now. And the main reason for this is because of the inconsistency of the interest rate policy in the US versus where fiscal is. And then looking at that relative to other countries, no other country is running 4.6% or so of interest payments to GDP today. Those are estimates for 2025, which I think could be even by the OECD, which I think it could be even actually, understating the problem given what we're seeing in terms of the composition of the debt, how much is going to be issued in the next 12 months. Just to give you guys some sense, 27% of the debt in the US is going to have to be reissued in the next 12 months. Look at the average rate of interest rates right now relative to where we are in terms of effective interest rates that we're paying on the debt. Things are going to surge even further from here. So I think that that's going to become a problem. I can see the Fed having to cut rates irrespective of where inflation is, irrespective of where labor markets are. And it wouldn't shock me at all. So to me, that's critical because I think currencies trade in a relative basis. And if we see a devaluation of the dollar versus other currencies, I think that's what takes the next leg up for gold. Now, it wouldn't shock me at all to see, much larger levels, another $500 move in gold very quickly. And so I'm focused on that. And to Larry's point, it's very important is the estimates of gold prices, not only from the street, but also from their own mining companies. There's a reason why these companies are being, not a lot of general investors are looking at them. And the main reason for that, in my view, is also has to do with the estimates for gold prices. You look at earnings estimates for most of the mining companies, they're awful because their estimates for gold prices are like 1850 still. And so, no, obviously, you're going to see issues in terms of the estimates and considerations of how much money they're going to make. And I think they're going to print money, in my view. I think that's going to change the whole landscape of investing in terms of the mining industry. And so I am solely focused on this because of my constructive view on metals like these folks have as well. And so this to me is the main part of it, is the interest payment to the debt that is completely unsustainable. Historically, we've never seen this before. I mean, I had a chart showing 2.5 centuries of history of interest payment relative to GDP. We've never seen this before. This is truly unprecedented. Not even in the 40s. 40s was, nothing close to where we are today. So, unpopular view, just to finish this. The debt problem is manageable, believe it or not. I mean, we've seen larger in the past. Like we've seen Japan is running way over the US. What is not manageable is the cost of the debt. That needs to be changed. It needs to be restructured. And that change will have impacts in other things like the FX market, in my view. And that's more I think this is going to be the change in the next 3 to 5 years.
As gold prices continue their impressive rally in 2023, climbing over 17% year-to-date, the precious metals performance is reigniting discussions about the mining industry's potential. This surge, primarily attributed to expectations of a weakening dollar as interest rates are anticipated to fall, has caught the attention of investors seeking new opportunities. The NYSE Arca Gold Miners Index, a key benchmark for the industry, has mirrored gold's performance with a 16% increase this year. However, despite this parallel growth, Tavi Costa, a respected macro strategist, expresses surprise at the persistent skepticism surrounding the metals and mining sector. He contends that current market sentiment may overlook valuable opportunities, particularly in mining companies that could substantially benefit from higher gold prices. However, the industry's response to rising gold prices remains measured. Victor Gobitz, the chief executive of Buenaventura, Peru's largest precious metals miner, offers a more conservative outlook. Speaking to Reuters, Gobitz suggested that gold prices would need to reach at least $1,350 per ounce to trigger new mining projects across the industry. Let's get back to the interview.
It's remarkable to see the level of skepticism given all gold has done recently. And it's one of the most historically unsupported views I've ever seen, thinking that the metals and mining industry won't follow this trend. And, we can see this from multiple fronts. I mean, I had a chart looking at the fixed investment happening privately in the mining industry relative to GDP. Back in the 60s, that used to be equivalent to about 16% of the economy. And today it's 0.3%. Now, you may say, well, we've seen technological advancements, the shrinkage of labor market because of the efficiency of how they run their businesses. But you don't see that drastic shift outside of really the US becoming more and more actually reliant on the imports of ore in general, which has been the case. And we're not seeing this as a critical industry just yet. And I think we will. And so the capital ultimately flows back into these businesses that are very complex. We joke here internally that, when you're modeling things and you're like, well, this thing could go wrong. It probably will go wrong. It's usually the case with the mining space. But these things can also can really print money in the right environment. And I can't think of a better time than now. You can buy companies trading even privately at 1, 2, 3 times free cash flow today. Of major companies that are trying to dispose their assets. They're not, they're trying to focus on tier 1 assets rather than having all these operating mines all over the world. And, to me, this is an opportunity for folks like all of us to have a strong view on gold prices. And one of the things I find remarkable is some of the estimates that we're seeing. All these companies, they estimate massive cost inflation, which I think it could happen. But then if you look at the metal prices estimates, deflation. How do you put that together? I think that if you tell me that the valuation of a company will be based on that, sign me up. I'm all in. I would love to buy a company that is being valued with those assumptions. And I think that's the case with almost the entire mining space. And now, if you can on top of that add real geology knowledge and to improve your odds, I think that that's really where this is a true activist field for investors that can take advantage of a lot of inefficiencies. And so the mining space is where, in my view, the real alpha is for the next 5 to 10 years, and hence why we've been spending so much time on this. Sim Zell once said that great money is made where there is a insufficient capital and lack of interest overall in the industry. And I take that to heart, because I think that that's precisely the case with the mining industry, where you have all this backdrop improving dramatically, and people continue to ignore these businesses. But if we go back to a little bit of there was a S&P Global research about the timing to produce to actually put a mining project into production, in average about 15 years, and keep that in mind that those 15 years, the research was made at over 120 mines and different projects that went from exploration to production that happened in this last decades, which have been one of the most globalized environments with low interest rates, with cheap oil. Imagine in the next 10 years. And so perversely, I actually think that majority of that timing, by the way, the 15 years, comes from a discovery process. So exploration stocks, being able to find a large endowment of metal. And I think this is an important, I think perversely, this is very positive for exploration companies, as most of these folks have already mentioned. We have a supply cliff for most of the major companies, and that ultimately also drives their interest in actually expanding their reserves. And if you look at the prices of the miners, why haven't we seen the junior side of it really reflect the higher gold prices? Now, I think it's also a function of metal prices, or I should say mining company prices, in regards to how depressed they have been. If you look at a price to net asset value of the mining industry overall, they've been as depressed as they could be. So it shouldn't shock anybody, but it shouldn't shock too much the fact that we haven't seen the M&A cycle really start. So this Philo news that I think Mike Gentile was referring to, it's a huge thing. It is a change.
After exploring these complex economic trends and their implications for the gold and mining industries, how might the disconnect between gold's performance and mining industry skepticism resolve itself in the coming years? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.